All right, we're back. Another week. Ready in front of us to go. And we're back with the AppliedMMT live stream. I've got Adam back on. Ryan, the plan was for Ryan to be here tonight. But the most important part of him is missing right now, and that is his voice, at least as it pertains to a live stream. The most important part gone. So next week, Ryan should be on. But anyway, Adam, welcome, man. How you doing, dude?
Thank you, Douglas. I'm good, man. I'm good. I'm doing well.
Chat, welcome.
Glad to be back.
Danger Zone. Welcome. Anyone in chat, make sure you jump in. Say hi. We got a good show for tonight. At least I think it's good. I don't know. Maybe it'll turn out to be underwhelming. Is everything proceeding as you have foreseen? Pretty much. You know, I do got to say a little sheepishly that for the last 2 weeks, markets have even exceeded my very bullish expectations. And I think it was Monday, 2 Mondays ago, we had a drop. One of the tools I use, my volatility shift tool, showed two spike. Essentially what the volatility shift tool is doing is it's anticipating future volatility. And when you get a handful of predicted volatility spikes into the future, it's usually where a top is at. So I went ahead and started hedging when we saw that. I do think we're a little overdue for a pullback. I've explained this in recent videos. Needless to say, I haven't gotten everything that I could have out of this the last stretch of this rally over the last 2 weeks. So is it proceeding exactly as I have foreseen? Yeah, maybe not, but pretty damn close, all things considered. So, but I guess I do need to admit the few times I'm wrong, once or twice a year when I'm wrong, I'll make sure and own up to it. But Brian, welcome, man. Thanks for jumping in. Jay, thanks, man. Glad you enjoyed the podcast. And speaking of podcast, Adam, you look like you're about to jump in.
Yeah, I was going to say, Coach Mills, thank you for the suggestion with David today. And he actually already reached out over email, so we're gonna work with him to find a time to do a podcast episode. Should be great.
Nice. Speaking of podcasts, we released one today, and we had with Derek, and sets up that next week though. We just got done recording. It's fresh in the memory, but we just got done recording a podcast. Yeah, last Friday, and it was with Brett Scott. Hopefully, am I allowed to? To tease this a little bit? It was phenomenal. I think we booked an hour. Ended up going 2 hours. It was a great discussion. Super good thinker. Really helped me, I know, clarify quite a few things in my head. And so I'm really excited to drop that, and that should be out by this week, by the end of this week.
Yeah. We're going to split it up into 2 episodes because we went for 2 hours, so we'll split it up into 2.
Okay.
But we talked a lot about crypto, Bitcoin, central bank digital currencies, and I think you guys will find it entertaining. A lot of great metaphors, and I think it was a great conversation. So I think you guys will like it.
I know I just had fun with the conversation, so that's good. And
Totally.
Jesus, I agree, man. The Derek episode was very informative, and he certainly has some really unique ways of kind of constructing a macro framework, and it was a helpful discussion. I know it took us a while to get that up, so it's not exactly fresh in my mind exactly how each blow by blow in the conversation, but I do remember it being very informative. I should probably just re-listen to it. All right, we're seeing people stream in and or stroll on in as the stream gets going. Let's see, Adam, I'm setting things up. Talk about the thing that is most on your mind right now. Go ahead and give a plug for everyone to go see what it is you saw while I get things rolling. Your love affair.
Was there something you had? Was there something you had in mind, Doug?
A certain movie. And then, and then I can, and then I don't have to, go for it. And then we'll get rolling.
So outside of MMT land, I saw the second Dune movie on Saturday, and 10 out of 10, perfectly executed film, I thought. Highly recommended if you haven't seen it yet. If you haven't seen the first one, obviously see that one first. Consider reading the book. But the second movie was great. Exceeded my expectations. The only downside is I think the next one, the number 3, which will be the final one, isn't supposed to come out until I think they're saying 2028 at the earliest. So
Damn.
we got some time.
Damn.
Yeah.
Okay.
Yeah.
Okay. So this is not Lord of the Rings style where they recorded them all at once, but
No.
okay.
Right. Yeah, so there's going to be a lot of time between this one and the next one.
That's wild. Eddie, man, thanks for dropping in. Thanks for saying hi too. Glad you could join the
Hello,
stream
Eddie.
live. You know what I realized I did, and this is or really what I should say I didn't do is I don't have AppliedMMT on the screen, but I don't know what it is that I was.
Come on, Doug.
I don't know what it is that I was watching last, and I don't know how incriminating it's going to be to turn the TV on and see what was on there last. what I was streaming last, like because I use like a USB stick to turn on the image. So yeah, I'm dropping the ball here, guys. Otherwise, I'd get it going. Maybe when we switch screens here, I'll pull that up. All right, we're going to talk bubbles tonight, and one of the comments actually on the last video, which made me think of this, and where's the feature that lets me drop a screenshot of my portfolio so you guys can rebalance me? AppliedMMT.com/join or whatever. I don't know what the link is. But that is where you can do it. What up, Monique? Welcome, man. Okay, we're going to talk bubbles. One of the comments last week was about bubbles. I tweeted out today kind of thinking on that topic and just about bubbles. And by bubbles, I mean asset bubbles, market bubbles, what causes bubbles. One of my favorite Twitter bellwether guys, like the quintessential like the quintessential Barron's cover, you know, like when Barron's like King Dollar, and the dollar's just ready to plummet, in half or whatever. The dollar's dead, and it's gonna is the bubble Jesse Colombo. And I remember this guy took this big break during COVID and came back on like March 28th to like the end is here, and like March 28th was the absolute low. And I haven't seen him tweeting in a while. And then all of a sudden, his name on Twitter is the Bubble, and all of a sudden, he's tweeting again. I'm like, dude, we are just getting started. If this guy is getting back on Twitter to warn us about the need for gold and whatever.
Is he a gold guy? Is that what he's?
Well, he
selling?
writes for a gold magazine now. I mean, he's willing to pitch whatever, whoever. He's willing to pitch whatever's willing to pay him the most, I think.
Whatever safe asset he's got.
Yeah. So with that in mind, the whole bubble concept, and I really feel like there are two things. There are two things going on here. And actually, guys, I'm still kind of prepping on the site. You know what? I think I already switched. To what it is that I was going to switch to. So it's too late now. And we'll go ahead and show that. I'll pull up later what I need to pull up. But we're going to talk bubbles, what causes bubbles. And I really feel like the combination of MMT and really kind of the heterodox space as a whole. When I say that, the work of Steve Keen was also very influential in this whole space. But I think it really explains what the heck's happening in what drives market bubbles and what ultimately causes them. And so I tweeted this out today, and we're going to go over this. And I think we looked at this maybe about 6 months ago, but I think we looked at it in a slightly different context in the terms of how you can make this a predictive model. But I'm willing to go over that again because I think it really drives home the sort of information that is actually within within this the data that we're looking at. And here's my overall point, is that asset bubbles form during periods where in the middle chart here is deficit spending. So you get deficit spending contracting. Now, like not MMT 101, but MMT 102 or MMT 10, maybe we're at like 200 level classes here. So MMT 201, but when deficit spending contracts and there still is a desire to increase savings, that can only come from one place, right? And that is one of the things we learn, and that creates an expansion of credit. right? That can only come from the endogenous kind of horizontal plane, right? So you have this vertical money that comes in from the government on high. The private sector can create money endogenously, and so as long as there is money coming from the government being spent into the private sector, increasing net financial assets, it's very hard to get a bubble. But when that contracts, all of a sudden, if you want expansion to occur, you need to get that growth elsewhere, and that is where this endogenous money creation comes from. Private credit creation is what ends up driving that. Now, since we know what money is, and we know that money is an IOU, and we know that money isn't gold or Bitcoin or anything like that, that real money is credit money. We know that it's an asset and a liability, and if it's a private credit creation process that's creating the growth, that means that the people that are gaining the asset, on the flip side of that, the liability, are just people in the private sector, right? So the private sector is bearing the burden of this debt growth, and so that's what the chart is on top. Now the chart on top is percent change year over year. Okay, so if you want, and I'll pull these all up each time series. So you can see them on screen if any of you guys want to pull this up after the fact, and if I can remember, maybe I'll link to this in the show notes after the fact. But total private total credit to the private non-financial sector is what you want to look out for series 1, and this comes from the BIS. And if you just type in this series name, that's how you can find it. And then you want to go to percent change year over year, and that gets you the chart in front of you, which was the top chart on the tweet. And the point here is that what you're really looking for is you're looking for these two things occurring at the same time, right? You're looking for the what I'll just call the fiscal flow, right? Deficit spending to begin to contract, right? And so we had this happen in and we're going to do this in real terms as well. We had this happen in 1975. We had this happen in 1980. We had this happen before the great financial crisis. I'm sorry, before the dot-com bubble. We had this event happen before the great financial crisis, and then more recently, we had this event in 2022, where we actually saw the expansion of deficit spending flip into contraction, right? So we actually saw that flip contracting. And so what has to happen when that occurs is, I'm gonna zoom this in, and I hand this up to the 1950s because this is where this time series begins. But just realize each gray shaded area in the background is a recession, and almost every recession is preceded by a sudden acceleration in credit, right? So the rate of change is increasing, and this happens, and it has happened over time consistently, that it follows this cycle. But if we zoom it into just the 1970s forward, where my time series of the fiscal spending happens, we can see that it coincides with this fiscal contraction, and the fact that we get this run up into the 1970 recession, this run up into the 1975 recession, this run up into the early 1980s recession. Now we did get this phenomenal period, this extraordinary period between the late 1980s and then 1990, before we finally had that recession. And part of this is because we were coming off a period of really high interest rates. I mean, we just juiced the financial sector. The other reason too is there was a lot of there were a lot of what's the word I'm looking for? Financialization was going on, and along with the financialization, the word I'm thinking of right now is escaping me. There was a lot of deregulation in the financial sector going on as well. So we really started to see things shift in the post-70 period. Not that the underlying structure wasn't all still there, but we really started to see a lot of deregulation. But again, notice that after the 1988-89 pop, we did still see that also important and characteristic of a pre-recessionary point, being that the sudden credit deceleration occurring heading into the 1990 recession. Again, same thing happening before the dot-com bubble, obviously great financial crisis. And then more recently, same thing in 2022. We did have a brief acceleration and then contraction. And again, I've called it, people have called it a soft landing. People have called it a, well, not people, I call it a stealth recession. We still had a contraction that took place. And it took place in conjunction with the subsequent contraction, or in conjunction with the not subsequent, but in alignment with the cumulative deficit spending contracting year over year as well. And so when these two things align, together, and here they are stacked over each other, that's when you get recessions. So in order to get a bubble bursting for a recessionary event to occur, you need this setup to begin with. You need the sudden acceleration of credit that creates the bubble, the fertile ground for the bubble. So those are really like the first two main components to how this all plays out. Adam, do you have any? Are you tracking? Is this making sense?
I am. No, I am. I think this is great, Doug. One thing I think would be additive to this chart is I would like to see what the Fed funds rate at the time there were these various accelerations in private credit.
I think that would be a good addition. I think we can do that. Maybe we'll do that by next stream to even add layers to this. Yeah, because I mean, in reality, okay, AppliedMMT is on behind me. You couldn't see that, but it is. When we switch back, it is. When we switch over to well, you know what I can do? Let me actually go to this screen right here, and let me go to. We'll add a line. We'll go Fed.
There you go.
Fed funds. Sheesh. We want percent, and we want it to be on the separate axis. Actually, it's fine. It's fine overlay. That'll be all right. There we go. Total credit. I mean, it looks like. I mean, one, there's clearly a strong correlation, which I think you would expect.
Yep.
And the reason there would be a strong correlation is because the Fed is one of their inputs is growth, so they're directly looking out at the market, right? They're directly looking out at what's taking place in the marketplace and seeing growth. And of course, growth is going to come from expansion of private credit. That's you're going to get the growth, and so they're going to see that as the need to raise rates in their cockamamie scheme. Any other thoughts on the correlation here that you're seeing, or just wanted to see how it looked?
Well, I just, I always think it's funny, that people attribute like these credit bubbles or euphoric bubbles to low interest rates. But if you look back at, the dot-com bubble and the housing bubble, the Fed funds rate was, it looks like, just eyeballing, it looks like it was higher than it is now in 2000, leading up to the dot-com bubble. And it looks like it was, what was it leading up to 2008? 5%?
Yeah, it did get all the way up to 5. I think it was 5.25 when they started finally cutting into late 2007. Yeah. Right.
So it's to me it's like the thing that the disconnect between the narrative and what actually happened is this idea that that low rates are what create massive credit bubbles. Like we can see that massive credit bubbles were created at a time when the Fed funds rate was around what it is now, right? It's not like you need a low Fed funds rate or a zero Fed funds rate for large private credit expansion.
Which, to your point too, and to kind of expand on the discussion, right? Really the strongest growth that we had of private credit that really exemplifies what this looks like was during the 90s into the private or into the great financial crisis. And that overall expansion throughout the 90s was all done while the Fed funds rate was above 3. And it was between 3 and 6.5, right? And we never got to 0. We got to 1 in 2004, but very quickly pushed higher into 2006. And then I'm going to stop. Well, let me just do this. Turn off the tooltip here, and then hopefully that'll stop the annoying tooltip. The other thing worth pointing out too, if we look to the right of the great financial crisis, is we just had stagnant credit creation during the zero round,
right, totally,
and
that goes back to the point that banks will not lend to people who aren't creditworthy, and that's the big issue that I think everyone misses.
Yes, exactly. And then all of a sudden too, we actually, I mean, one, you start seeing rates tick up, before COVID, and then two, rates notwithstanding, we did have a massive stimulus program that happened post COVID, which is in our mind
Right.
going to juice credit markets, right? Because
Yeah,
you're
100%.
to me, to capitalize the banking system means two things. The first, banks just have capital, and then two, individuals have income. Those are the two things necessary to see a credit cycle take place.
And don't forget that a lot of the COVID payments that went out were used to pay down existing debt.
Yes. Yes.
Which obviously creates more room for additional debt.
Yeah. Once the next cycle begins. Exactly.
Yep.
Exactly.
Yep.
Yeah. So we had this. We did have this great this kind of Goldilocks period. I guess my point is, the counterclaim could be, well, why did we get this massive credit rush post-COVID if rates were at zero? Doesn't that counter the overall idea that we're bringing up here? My point is, no. What's the problem with low rates is it just generates very little income, but the income was being generated by the government spending at that time frame,
Right.
And
Right.
individuals
Yep.
deleveraging and then preparing themselves for the credit binge that went subsequent. So. The last point in this, then, going back to this now this is total credit to the non-financial sector relative to GDP, is there does seem to be, and this is kind of the final point of the tweet, there does seem to be this point at which, and I can try and explain the dynamics. In fact, someone asked me the dynamics when I wrote it out. I thought, God, I wrote that out very eloquently, so I'll probably just read exactly what I wrote. But you do eventually hit this ceiling, and there's reasons for this ceiling, but you do hit this ceiling of private debt to GDP that just starts to create some wonky dynamics. And as it stands right now, 170 seems to be that place. It'll likely increase during this next cycle, but we'll see what that ends up being as the next cycle plays out. The big takeaway that I want to hit on here before we move to the next point is we are not in a bubble. We're not in a bubble until we start seeing that rapid acceleration. It will happen at some point. Like it is bound to happen. We've never not had it happen. The point is we're not there yet, and we're at the very beginning stages of really what is that whole Minsky instability hypothesis, where you go from sound expansion of credit, where you're only taking on the most likely to succeed ventures, and you move all the way up to the point where you're taking on huge risk. This is from the banking sector. You're taking on huge risk, all the way to the point where you're just issuing loans on the pure speculation of asset prices going higher, which allows the asset prices to push higher. And it's that last bit that really sets the stage for the bubble, and the dynamics that are underlying this credit cycle that can create the foundation or create the situation for this bubble to pop in. And this will be, I'd probably just bring this up here. This will be where then the question comes in. So why does this whole process stop, is effectively what he's asking, right? Why do we roll over? And this is where the work of Steve King comes in. And I'll bring this video up in a few minutes. I didn't have it prepped before we went live, but the reason that this stops is that the way the way the math works out, there's this inflection point, and it really is an inflection point based on where the total load of private debt to GDP is, where the acceleration of credit. So we're talking the second derivative, right? So we're not even talking like the change in credit, but it's the change of credit. So the acceleration needs to continue to increase, right? So the acceleration needs to continue to go from say like 1 to 2 to 3 to 4. So we're talking the second derivative. So that just means the first derivative is jumping more than just the acceleration at that point, right? So we're actually seeing a true increase in the acceleration, right? So you're full pushing the pedal down on the gas of the car, and the kind of the fuel to keep that acceleration and the ability to generate the necessary acceleration deteriorates as the overall private debt load gets larger. So I don't know if I can think of a good analogy here, but eventually you just because the more the credit expansion occurs, the more it takes up as a portion of private debt, like the more fuel needs to be added to this system to allow it to accelerate. And short of one, massive government stimulus, or two, a major change in the regulatory environment, it just hits the speed of light, right? I mean, it just hits the natural bounds that the system can support. And when that happens, deceleration occurs. And then that starts, and again, I think Steve Keen is absolutely right in this. That starts what we all understand is just not good for a business cycle. All of a sudden, profit margins get bitten into a little bit. Companies need to make profits. They have loans they have to service, so they're going to start paying wages, or they're going to start paying lower wages. And if they still can't meet the need to service their debt, they're going to cut people. They're going to lay people off. Which, once that starts, you're already two nails into the coffin. One, you're just creating fewer new loans, right? So that in turn slows down the process. The other thing too is you're also now killing demand because hiring is stopped, and then it just is a domino effect after that. A crunch in demand all of a sudden means fewer profits, which means even more cutting. And until you get the automatic stabilizers to kick in, which the automatic stabilizers in this case are going to be unemployment and government spending, everything collapses. And that's exactly what we saw in the great financial crisis. And in the great financial crisis, you just had a lot of people. You had a president going out, you had a new president coming in, just a lot of people that were not doing the right thing at the right time to allow things to properly get restarted back up with the strong fiscal impulse that was necessary. Which, final point I'll make, when we look back at the cumulative deficit spending year over year, always happens after recessions, right? You get this massive fiscal acceleration that takes place after every recession. And this is, again, this is the space that we're in right now. It's this massive recapitalization of the private sector, and then that whole cycle is allowed to repeat itself. So that is the bubble discussion.
It's funny. It's funny. Like, it's very fortunate that we have the automatic stabilizers in place. One of the things, I forget when or where Mosler said this, but Mosler at one point, I think it was around the time COVID happened, when there was kind of some debate around, how the government would handle the whole thing and how it would support the economy. And he said, the deficit is going to expand either the easy way or the hard way. And the hard way meaning you can just let the automatic stabilizers do their thing, and we could have a slow recovery, or the government could step in and voluntarily, kick in with the fiscal spending in addition to the automatic stabilizers. And we ended up having a very fast recovery because of that. And I think it's a good way to think about it. Like, the deficit, when there is, when the cycle does come to an end, or there is some kind of exogenous event, the deficit will expand one way or the other, and the economy will recover. But the question is, like, how long does that take? What policies are enacted to make that happen? It's important to recognize that, like, even if the government doesn't do anything, the automatic stabilizers will kick in, and the deficit will expand. And it can be painless, or it can be very painful.
And so far, it's been relatively painless, but we might get painful. I don't know. A lot of chatter out there about reducing the deficit. We've had a deficit. How many years has this country existed? 235, 37? I don't know. I should probably know this. Probably be an American test of some sort.
248.
248.
This 4th of July.
Holy cow. We're close to it.
Close to 250.
We've had a deficit probably 230 then. 240, 250 out of those 248 years or whatever. And yet we've never run into. We've effectively ran a debt, except for apparently Andrew Jackson paid it off one time.
And it was being, the Clinton administration ran some surpluses, and Kelton frequently talks about how there was actually a time when the federal government, like I don't know who it was in the government, Council of Economic Advisors, whoever, they were saying, is there going to be a time when the government does not have any debt left? Like that was what they were projecting, because they were running surpluses for several years in a row.
Ukulele too. Ukulele, I'll call you. Thanks for the super chat. I'll talk Bitcoin in just a second. Let me finish the thought about deficit spending. The point is, we've had a national debt for hundreds of years now, and it's never become a problem. It's never. And if anything, we've had this expanding period of deficit spending for the most part over the last century, and the U.S. has become the major superpower in the world during that time, and all the innovation. And maybe you could make the argument that innovation would have been better had it not been the case, and that's fair. But the fact of the matter still remains is that we had deficit spending, and the brief period that we didn't in the late 1990s led to the worst double dip recession, almost depression, that we had since the Great Depression. So I don't know. I think we're safe with deficits for now. All right, we can get some questions. Ukulele me too. We'll go with yours first. Do you still think Bitcoin is a Ponzi? I think it has. I do think there are Ponzi characteristics as far as I understand the way Tether works. I do see Bitcoin. In fact, if you overlay Bitcoin with the credit cycle, it is a very good early indicator of the credit cycle. Bitcoin and gold have always had this. Gold has always had this, and I'm seeing Bitcoin have this exact same. Oh, I'm sorry, guys. I thought this was pulled up on the screen. Let me go and pull that back up on the screen. If you pull this up and you look at bank credit or something like that and overlay with Bitcoin, usually Bitcoin, gold both take off right before the big credit cycle is going to take off, and they're very early indicators. And to me, the reason for this is because of credit creation, creating new money, and that money finding itself in a risk asset. So it's an indicator to me that those two things, no pun intended here, are tethered together. So it has Ponzi elements to it. And I would imagine if we ever have a massive deficit reduction, like we did in 2022, that Bitcoin will take a big hit. With that being said, I mean, I have used Bitcoin before for a few projects. So I mean, it has utility. I don't deny that it has utility beyond just the simple function of speculation, but the utility isn't all that much. And we were talking a little bit before we went live how high Bitcoin could go, and I absolutely think, because I think it stopped right at 69,000 prior. I think it's at about 60,000, right? If I'm not mistaken, is that where we're at? Chat, can you confirm? So it wouldn't surprise me at all if we push higher.
That's 68.5 looks like.
No kidding. So yeah, we're about to make new all-time highs. Yeah, it wouldn't surprise me if it pushes higher. I won't tell you what crypto I sold recently 2-3 months ago, that if you check the price out today, 10 bagged in the last week. Jay Mills figured it out. What projects necessitating bypass legal tender laws? Give me a year. Let me finish the project, and I might be willing to divulge one way or another. It's not illegal, but yeah. I still, going back to the Bitcoin question, I still think it's a bit of a Ponzi. I still think there's a correlation there with kind of Ponzi type speculation, very speculative. I certainly don't see it as money or a replacement for money. Adam, I don't know if you have any thoughts on that. I'm going to read through chat what you think.
Yeah, I actually think it's pretty straightforward when you boil it down. And honestly, our conversation that we talked about, that we had with Brett Scott recently, I think Brett referred to Bitcoin as a money branded collectible. And I think that's the best way to think about it. So if you think about it, it trades like any market as if it were a trading card or if it were a rare watch. All it is a money branded collectible that trades. And if there's more demand for it, the price will go up. I think there are a lot of shady actors that are in the space to manipulate the price. I think that I think it has the characteristics of multi-level marketing. Like if you're in it, you become an evangelist for it because you're hoping it goes up in value, and it will go up in value if more people are in it. Um, so I mean, that's how I think about it. I think of it, to me, it's no different than buying a rare trading card and hoping it goes up in price. But it's obviously highly liquid and it trades as if it were a stock or a commodity or something like that. I would just say, if you are into Bitcoin, look into what's going on with Tether, and try to protect yourself.
Django Geek with the $5. I appreciate it, man. Let's see what Django Geek has to say here. You only get Ponzi bubbles when the non-bank sector are in negative equity, but deficit spending puts non-bank in positive equity, so bubble less likely. Yeah, exactly, man. Exactly. That is, that's kind of exactly, I guess, what Steve Keen, kind of his main point is, and I think you summarized it perfectly in that tweet. Thanks for the super chat. I'm looking at this. I've never seen this. Let's celebrate their 20th super on a live stream. You've been here for 20 super or 20 streams, man. I appreciate that. I'm gonna see what happens when I click this button, guys. Nothing. Okay. Sorry, I've got this. I've got all these fancy things popping up on chat. All right, we did have some other questions. Thanks again though for the super chat earlier. Do you guys think the valuation of the Indian stock market? What do I think about the valuation of the Indian stock market? Do tax strains affect their markets as well? Also, how does a switch to low interest rate environments impact the Nifty? I'm not terribly familiar with. YouTube glitch. Okay, Django. Yeah. All right. Well, YouTube glitch. Still, thanks for the super chat. I don't follow. I get this question from time to time, just about like some other country or some other region. I don't follow really any other region all that closely. I do know that it's very difficult to get data in markets outside the U.S. that's anything but quarterly. Everything that I'm showing you here, I believe the BIS has some sort of tracking equivalency, but the U.S. literally puts out a daily treasury statement. I don't think any other country comes even close to that. Many countries have monthly treasury statements. I don't know how to read them all that. I mean, it took me a long time to figure out how to fully understand the ins and outs of the way the U.S. reports and what everything means. But if you just go to the BIS, look at credit to the government, credit to the non-financial sector, you can get a pretty close approximation for where you're at. With that being said, as long as a government issues its own currency, taxes its own currency, doesn't borrow too much in currencies outside of its own country, everything I'm saying here should remain applicable. That big thing is what sort of debt are they issuing outside of their currency. So if you want to look up your own country's information and data and apply this theory accordingly, you're going to get a similar result. Taxes will always drain financial assets out of the private sector, and that will always that will always be a drag then on the economy of that private sector. The big thing is, the rest of the world is very dependent on the Eurodollar system, which is very dependent on the U.S. spending. And so much of the rest of the world follows the U.S. just because the global credit cycle is the Eurodollar cycle, which also tracks the domestic U.S. credit cycle as well. So I hope that helps and kind of clarifies things. I don't follow India and Indian stocks too closely, though. Do you guys, this is a good question next up, do you guys think there's a chance of a second coming of inflation that the Fed, that forces the Fed to hike rates higher? You got any thoughts on that, Adam?
Yeah, I mean that's kind of, we've been talking about this since the end of last year, and our prediction was that all the rate cut talk was way premature. We expected that inflation would start coming in hotter than it has, sooner than it has. So yeah, I expect inflation to continue to come in hotter because of the interest rate, because of the rate hikes. And I think that the Fed's only reaction to elevated inflation is to continue raising rates. Um, so I would not be surprised if that continues to be the case.
I'm in a I'm in alignment, I think. I'm pulling up some charts here as we speak. Let's see. This is really interesting. I had a good conversation. Actually, maybe this could be our discussion topic for next week in inflation. But we had a really good discussion with just a brief back and forth on Twitter with Bill. I don't know what his Twitter handle is.
Oh yeah, Wabuffo.
Yeah,
Wabuffo. Yeah.
Really smart guy. Really understands the ins and outs of the monetary system as it intersects with the fiscal system, as it intersects with the financial system, and as that intersects with the real world. Very smart, very well informed, and he has been on a very much on a kick that inflation's not going to be going higher anytime soon. And he's just been right about it. And so I asked him, okay, give me your underlying thesis for why this is. What's your inflation framework? And I'm in full agreement with this framework, and that is effectively that during a period of growth, it's hard to get inflation because inflation is going to happen when you have a shortage on the supply side. And as long as that growth is productive growth, meaning supply will always be catching up because you're getting an expansion of growth. By definition, you're expanding, growth is expanding. You're able to meet the new demand that's coming in, that it's going to be hard to get inflation. And I'm very sympathetic to that view, which is why I've always kind of couched my, I think inflation's going to go higher view with, but I don't need it to go higher. In the sense that it makes sense if we start to see surprises to the upside. I think that's what I'm anticipating, surprises to the upside. But I don't need inflation to take off, and I don't think inflation's going to take off like to the point where it undermines each new dollar coming in and the veracity and the potency of each new dollar and the efficacy of each new dollar coming in as a fiscal flow.
Right.
I don't think that becomes a problem until oil really takes off. And so we really, if we're going to see inflation, it's going to be like the good kind of inflation. And by that, it just mean prices are hot, things are going fast, and you're seeing strong acceleration in growth as a consequence of that. So overall, yeah, I think inflation continues to rise. Does it continue to, or do we see a strong acceleration? Not until you really see something that dislodges the supply chain, and the easiest way to do that is just jack oil prices through the roof. And I'm inclined to think that Warren has the right take on this, and that the Saudis and the various actors in that space could do that. That makes sense to me, and we could get kind of a replay of 2007, 2008. In terms of where we're at, I think we covered this last week, but we continue to see. Let's pull this up real quick. I know this isn't on your screen, but we'll bring this up. CME here, the CME Fed Watch tool. So this is for the May rate cut. And again, going all the way back to the beginning of February, it was almost 100% that we were going to get a rate cut. And now we're hovering right around 80% that we're not going to get a rate cut at all. So again, just think this through. February 1st, it was 100% that we'd get cuts, to March 4th, 1 month later, that there's no chance of a cut by May. And if we're on this trajectory, it wouldn't surprise me by the end of the year, and we've already started to see hints of this, that we end up getting rate hikes when it's all said and done. And if that happens, like, ooh, baby, like that is like, we'd continue to go down the Goldilocks path for this economy, because we're just gonna continue to juice the fiscal there, and yeah, I mean, debt is big. Everyone talks about the consequence of a large public debt. The consequence is when you raise interest rates, that just juices things even more, gives out that much more kind of free money. So, good question. I always really enjoy that question, and maybe we'll dedicate an entire episode. Also, just to kind of tease some things that we're working on. It might take a while, but this is one of our research projects that we're working on, trying to essentially do what we did with Deep MMT for inflation, because we see this as one of the most important pieces for understanding bonds, where bonds are headed. Obviously, if the Fed is inflation focused and they're setting the interest rate, bonds are going to follow inflation, and that, you know, that could give quite the edge if we can crack that code for where bonds are headed. All right, Renan Oliver, great question, man. Appreciate it. Let's see. Hey Zeus, question. In the Derek episode, you guys mentioned paying $12 a month for checking. I was wondering, would you guys consider credit products glorified checking accounts? That's how I've been. I don't know. You have any thoughts on that, Adam?
$12. I don't remember that part of the conversation.
Yeah.
Was that like a $12 fee for a checking account?
I don't know if I remember that part either. Must have been something along that line.
I was wondering, what would you guys consider credit products glorified checking accounts? Don't really have a take for you on that.
Yeah. Hey Zeus, clarify if you want, and we can swing back around to that. Eddie, so if I understand correctly, contraction in deficit spending leads to accelerated growth in private credit. Accelerated growth in private credit leads to a bubble if there is no stimulus behind it. Yeah, I mean, effectively, that is how it can play out. Now, it doesn't necessarily have to be just the credit cycle will be whatever it is, and depending on how a contraction in deficit spending occurs and at what level it occurs and over what time frame it occurs, it can impact the credit cycle in different ways. So I would say there's necessarily kind of a causal link between government spending contracting and necessarily leading to an acceleration of credit. But if growth is going to continue immediately, there will be that acceleration. So yeah, effectively, that's not. Yeah, with that one qualifier in there, that pretty much is correct. Ukulele me. I see you also saying that you admit Bitcoin is the real deal now. I've never. No, I don't think it is the real deal. But go ahead.
I was going to say, it depends what you mean by the real deal. Do I think it could go to $100,000 or $1 million? Sure. If the institutional structure remains so that people can buy and sell it freely, and all this tether keeps being pumped into it, sure, why not? Do I think it's the real deal and that it's a replacement for actual dollars? Absolutely not.
Couldn't have said it better myself.
Okay.
Yeah, I agree. All right, I'm catching up on chat. Adam, I don't know if you have chat up, if you're seeing anything come in that needs to be hit upon.
I can see chat. Let's see. Food inflation. You wanna pull up Jay Mills on food inflation?
Don't know if I see it. I'll keep going. Food inflation. There we go. Seems to be really hurting lowering income families. Yeah. Go for it.
Yeah. I mean, I think that is. I've heard. Everyone seems to be talking about that, and I've obviously noticed it myself. Like it is kind of crazy, the grocery bills these days. And that's obviously something that people notice. Everyone has to buy food unless you're exceptionally wealthy and someone buys it for you. But, most people are going to the grocery store and buying food, and most people are noticing that. And yeah, I think that's a huge problem. I think that a lot of that has to do with consolidation. A lot of it has to do with, companies increasing margin during the pandemic when inflation was a hot topic. And it's very unfortunate, but I think we would argue, and the data supports this, that real wages are now outpacing inflation. It's really just, I think people unfortunately are going to have to get accustomed to higher prices, and we have to hope that wage growth benefits those at the bottom as well. It's really a distributional thing, I think.
Yeah. I think I'm in agreement. I was also kind of reading chat, but I think I was tracking, and I think you're on to something. The other thing too is, in terms of like the overall macro, this really sucks. I'm not saying this doesn't suck, but from an investment, trying to make an investment decision, the bottom half being squeezed is they can be squeezed for a very long time. Again, I'm not trying to say, that's like a good thing from a policy or political standpoint, but from a macro standpoint, the impact of that is relatively muted. I mean, it'll take a while as it kind of inches up that up the spectrum. Good question though. Let's see. I did see Ty jumping in chat saying hi. Yes, glad to be back at it. Thanks, man, for dropping by. I've seen a lot of new names in here as well. John, thanks for joining. I gotta shout some names out here. Vladimir also, Jesus, said hi. Thanks everyone for joining. By the way, we're at 9 likes, and I've seen about concurrent viewers hit about 30. So if you're not hitting that like button, smash that like button and
smash that like button.
Adam, any other thoughts for tonight?
I think one of the things that I think is interesting, and I saw Warren, thank you for the like, Monique. One of the things I think is interesting that Warren pointed out is home prices. So that's one of the things you'll constantly hear people, talk about when it comes to rate hikes. Well, if rates are higher, less people are going to be borrowing, and if there's less demand in the market, then home prices are bound to come down. But if you look at the actual the home price indices, there was a brief dip when rates increased, and now they're like right back on trend to where they were. And I think that that really it goes back to what I think is so core to MMT, which is like you must look at real resources, distribution of those resources, and it's not as simple as saying just like raise or lower interest rates in order to affect the price level, right? I think a lot of what's happening is, people that are able to are now coming in and buying homes with all cash, whether it's for themselves or for their kids. And a lot of this inventory has come off the market because people don't want to sell a house to get a mortgage at a higher rate. So again, like, must pay attention to the real resources, what's actually happening with the housing stock, and not just assume that the interest rate is going to affect the market because there's going to be less or more demand for loans, right? So that is something I'm tracking because, my wife and I are obviously, we're loosely considering buying a house, and it's something that's kind of near and dear to me right now.
Yes. Yeah. Amen.
Yeah.
This is, I think the big takeaway is, it's all one big circuit. And if you change any input to the circuit, you need to follow the circuit all the way through, right? And understand the impact from each angle of how this thing transmits throughout this entire system. And I think a lot of people just immediately see like a one-dimensional take, higher rates, make things more expensive. Yeah, but then when you play it all out, it also changes the dynamic of supply and demand and what comes to market or what doesn't. It also changes the income. It also changes the income distribution. It changes the entire look. And I think that's just, it wasn't thought all the way through, and at least the people that thought that this would be a nail in the coffin for the U.S. economy, what each step was doing along the way. So,
right.
Yeah, I hope you guys can find a good home. My wife and I too. We've had a few chats, and it's like, sheesh, gotta save up cash to do that, because my 2 whatever rate loan that we got, we closed on this house like February 20th. I want to say late February of 2020. So like we were, I think like a week later, rates hit the lowest they ever did.
Right.
And so we were pretty darn close to getting the perfect Goldilocks rate, and that would be very difficult to give up. But We got Ty Keynes with the super chat, $5 Canadian. This is a credit on my credit card and a debit. Confusing, I know. Remember, your bank statement is the accounting perspective from your bank. Thanks, Ty, man. I appreciate it. Thanks for dropping in.
I love it, Ty.
Yeah, really.
Ty, by the way, I want to add that several people said we need to have you on the podcast when I tweeted out who should we have on our podcast next. So you're welcome to come on whenever.
Yeah, absolutely. Hit me up, man. Hit me up. Hit any of us up, both AppliedMMT or myself on Twitter. Thank you, though, for the super chat. What was I going to say? Oh, yeah. I was just going to put this on screen, do one of these, and not comment at all. What else did I want to hit on? We're coming up to the hour here. I wonder, to what degree do bubbles occur if public deficit spending and private debts aren't going to productive ends, or are they all considered productive from an accounting identity perspective? Yeah, good question. Good question, Jay. And the answer is credit expansion near the end of the cycle absolutely goes to very non-productive means, and that is very much what causes the bubble to finally occur. Is the fact that, and actually, oh yeah, I do have it pulled up now, so I'm just going to switch over to that screen. If you type in Prof. Steve Keen Minsky, no, this is not. Yeah, here we go. This is the video. Minsky at 100, deriving and validating the financial instability hypothesis. Steve Keen, if you look up, various debt deflation, like here's a debt deflation video, various kind of debt theory videos, they're all worth watching. But this 53-minute video, I think, encapsulates the best of his theory and the best of the work that he's done on Minsky in one video. And the drive, the point that you need to kind of drive home for understanding this as it pertains to speculative financing and ultimately the bubble bursting is, at some point, banks start creating loans. So this means new money is being created endogenously, right? The loan is creating the deposit. You're getting an expansion of the money supply for the sole purpose of increasing the very asset prices on their books. And this is when they get into that speculative financing, which creates the potential for this negative equity situation that occurs when those assets start to fall and collapse. And then you get the actual business cycle to roll over, and you get a complete collapse of the system. So it's a combination of multiple things all happening at once that are all interconnected at once that inevitably will happen all at once, short of a public sector intervention that leads to kind of the catastrophe. So you can still get bubbles, and to a certain extent we kind of got that, and maybe into late 2022. I'm sorry, late 2021. Maybe we were getting a close to kind of bubbly scenario coming up. But the government very quickly intervened by raising interest rates and kind of resetting the cycle. So we never got the worst of it. But yeah, Minsky at 100. I think that is the best summary of everything that he does. I would check it out. And unfortunately, not unfortunately, but at least the way I listen to YouTube videos at 2x speed. Steve is a fast talker, so that's a real 53 minutes there. That is no 2x speed. That's a real 53-minute video, but worth every minute of it. All right, we got a few more questions, and then we'll probably be wrapping up for tonight. Do you think the stimulative effect of higher interest rates becomes stronger than the cooling effect of more expensive lending? When was that inflection point? How much debt did it take? All right, I got to reread this. I think there are a few parts to this. Do you think the stimulative effect of higher interest rates becomes stronger than the cooling effect? Yes, I do think that is absolutely initially how it starts off. As the cycle progresses, in part because, and I think this is the piece that, again, going back, I know I mentioned this a million times, but Riddick Goyle's whole point that it benefits the banking sector to have higher interest rates. It allows them to make more and more risky loans because they're getting this free interest income. When is that inflection point? The exact point right now seems to be about 170% private debt to GDP, and that's when you need a force of acceleration to be there that's just not there. So, Adam, I don't know if you have any other thoughts on that, but didn't want to cut you. Okay,
nothing, nothing additional there.
Okay. Django, really good point here. Yeah. The natural cycle of capitalism is to go from productive investment to speculative investment. I agree. All right. Yes. Steve Keen's 1997 PhD thesis, if you like reading, I think is a great place to go. All right. I think I got time for one more question. So, unless Adam, did you have anything else you wanted to bring up?
I don't think so. Yeah, let's do one more question. Thank you guys all for joining tonight.
Yeah. We hit almost 30, so that was awesome. I appreciate it. Seeing some likes come in as well. Super chats, much appreciated. Allows me to buy that fifth cup of coffee for the day to get extra juice for the live stream. I'm skeptical about higher rates being inflationary as Mosler posits. How do we know where the interest income goes? Wouldn't higher income earners put them into equities? Yes. I think all the work I've done. Let me pull this up. I had a tweet, probably a year ago now, where let's see. I think I pinned it at one
Doug,
point.
do you mind if I pause you?
Yeah, go for it. Yeah.
So Jay, I think it's important to recognize that it's not just the interest income that Mosler's talking about. It's what he refers to as the term structure of prices. So there's a YouTube video that let me find it and I'll send it to Doug and Doug can put it in the chat. But I would watch that as well. So the income is one factor. Another factor is what Mosler calls the term structure of prices. So it's important to consider both sides.
Post that in Discord and then I'll put it in chat.
Okay.
Let's see. I tweeted this out. If you go to, let's see, if you go to my main Twitter page, you click the pinned tweet, you scroll down. I posted June 11th. I posted this, and if you can follow the logic here, it's a 4-parter. If you can follow the logic here, and I draw very convenient little lines to connect the thoughts here. If you can track the logic. The whole point is the entire system just pushes the price level higher. And I think the two pieces that are missing, and the work that I've done, kind of statistically, is it does seem like capitalism continues to take place. And what I mean by that is people demand higher wages when prices go up. And if the new income isn't there to support those higher wages that workers are demanding, then they just have to lay the workers off, or the demand. Well, yeah, I mean, you get that situation where, one, they can't meet the higher demand for the higher wages. Two, they still have to push the price of their goods and services higher to meet the profit margins they need. And then when that starts to when that becomes insufficient to meet the profit margins, then they start to lay off. So that part of the credit cycle, if that plays out, will be the necessary kind of domino effect to start things start the process rolling. However, as long as the income is there to meet the demand, no one who's receiving this additional interest income, whether it's like a large hedge fund or that is going to use some of that money to invest in companies and whatnot, or if it's a lot of these companies too, like Coinbase and whatnot, right? That is the largest line item of income they have right now is from interest income, because of their profile, because of their treasury profile, right? They're gonna pass that along to the higher wage demands from employees, and it's there for the taking, right? Like they have the income to do that. So capitalism continues, and if they're unwilling to do that, then those workers are going to go elsewhere. So the company still needs to to be competitive. It's still likely a company that could be at any day out of business, right? If they don't have the right employees and the right structure to continue to succeed. So that process still works, and then that allows higher income for workers, which allows them to still continue to buy goods, services, homes, everything that they need, cars and whatnot. That still continues to drive the economy further. So I think the whole cycle fits, right? It's really when and only when, and then because of this, that increases the price level across the board. Now, again, does that mean like the inflation that we all hit that we saw in 2022 takes off? No, but does the price level, all assets, continue to rise higher in that environment? Yes, I do think that is what takes place. Up until government spending gives way. And then when government spending gives way, you need those asset prices to stay elevated, because that gets banks close to a negative equity scenario, which causes a sort of Minsky crisis to occur. And that is then when there is no more new income, fresh income for the private sector, and then you see the things collapse. So I hopefully succinctly but thoroughly enough kind of explain how that went. All right,
Doug, I sent you the link, by the way.
Okay, so this will be the last thing we do. Yes, this is exactly it. So we'll go ahead and copy the link. We will pop this in chat. And on that note, and that is a really good video. That entire discussion. There have been a handful of things that have just clicked for me over the years. And that was one of them, where when he explained that, and I'm like, oh my God, I can see it. And one of the things that I saw, which is in the tweet that I just showed, is that whole term structure of prices thing. Like, you can see it. You can see it in the price structure itself. You can see it across any asset that has a term structure for delivery for that price, or term structure price for the delivery of that underlying commodity. Like, it exists, and it tracks the interest rate. And that was very much a coin dropping, light bulb on, whatever analogy you want to use, moment. So we got Ty. I was really hoping you guys could define the meaning of life from a national accounting perspective. Maybe next time, man. Maybe next time. All right, crew. Another great live stream. Thanks everyone for dropping by. Great questions, and I really appreciate the questions too, man. This is really I was really hoping season 2 could be as much question driven as it was kind of us just explaining what it is that we're thinking driven. So bring the questions, and definitely be glad to dive into that for a while. So with that being said, Adam, thanks for joining again. Everyone, thanks for joining.
Of course.
And yeah, logging out. We'll see y'all next week. Have a good evening, everybody. Bye-bye.
Thank you, guys. Have a good one.